Hello, everyone. Welcome to the final bar. A brutal day for equity investors digesting a huge down move, unlike anything we've seen in quite a while. Days like this are more characteristic of bear phases than bull phases, but this is coming off of significant highs for a lot of stocks. So we're going to try to make sense of what happens in 30 minutes. I feel like we need 30 hours to try and debrief on this. We're going to do our best, look at the chart, see how the long-term trends are affected by what we're seeing. My guest, Xenia Taoubina, hopefully will help us make sense of things as well. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to today's edition of the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a rainy Redmond, Washington. Thanks for joining us every weekday after the close to make sense of what's happening as much as we can. Try to connect the short-term movements of today with the long-term. Up until today, we've talked about the overbought condition for stocks. We've talked about, technology as a safe haven and the flock back to things like Microsoft and Apple holding up so well. We've talked about financials starting to weaken, and boy, today felt like an exclamation point to that more cautious outlook with stocks, continuing on. The saving grace of the market was the fact that the close came at 4 p.m., pushing the S&P right almost to the penny to the 3,000 level. So my guest, Xenia Taoubina, hopefully we'll try to make sense of what we've seen here. And again, the goal is, this is one day among many, although it's a significant one. Let's see how this affects the long-term perspective. Now, coming up, we're so fortunate to have great guests coming on our show to help us make sense of things. So I wanted to remind you some things coming up on StockCharts TV. On Monday, our next episode of Behind the Charts features Mike Turner from Turner Capital Management, a quantitative money manager, uses a lot of technical input. So a really interesting conversation talking about more rules-based technical systems. On Tuesday, the 16th, we have Jeff Greenblatt. On Wednesday, the 17th, Jay Pettit. And on June 18th, Bruce Powers joining us as well. Earlier today, if you missed it, we just recorded The Pitch. We're going to be playing it today, and you can find it on our YouTube channel as well. This is where we have Tom Boley as a StockCharts moderator. We have 3 guest commentators who provide some ideas, pitch you their equity and ETF ideas. Then they have a conversation and sort of debate their strategies. And what a day to record that. Just recorded it a couple hours ago. Really, really well done. So you're going to want to check it out and just see what they're thinking in this sort of environment. Let's go right to our market recap. So by any measure, this was certainly a day of weakness, a day of follow through to the downside. If there are questions on, whether this was a double topping sort of pattern, I think today certainly seemed to confirm that it was at least somewhere in that realm of double toppish things that I've seen going on market history. Let's look at some of the movements today. Let's look at some of the broad market charts. Let's get to some themes as much as we can. The S&P finished almost to 3,000 yesterday. I remember saying something like, on any pullback, let's look at the 200-day and see how that serves as support. I didn't think the next day we were going to get all the way down there, but the S&P down almost 6%. That put us to 3,002 about at the close. Mid caps down over 7%, small caps down over 8%. So this was certainly a risk-off measure by any stretch. The VIX now above 40 again. This had been down in the 20s to 30s for a little stretch. Now back above the 40 handle, which is pretty significant rise. Yesterday it was at 27 and change. So it shows you the change, the increase in volatility that today has affected. Bonds actually did very well. The question on a day like this is what actually went up, what worked on a day when the broad equity markets were down so significantly. One answer is bonds, with the TLT up almost 2% today to almost 164. 10-year yields down to 65 basis points, which is a huge downswing from where they were yesterday. The dollar also stronger, and the dollar weakness is one of those themes we've talked about. Today, certainly a reversal of that on the short term, up 1% on the UUP. In the commodity complex, again, a lot of people think of gold as a safe haven. A lot of times that is true. Today was not it. So gold was actually down along with most commodities. A couple commodities like natural gas up a little bit, but oil really drove the way down in the commodity complex. This pushed the energy sector down almost 10% today. So if you look at a sector read, this has been a rotation that's happened over the last week, really, is we had this period where financials, industrials, energy, materials really rallying, things like technology, healthcare at the bottom of the returns list. You can see today this was a move way out of that trade and an unwinding of that trade, if you will. So the stock's really getting beaten down. It's things like airlines, which are down huge. It's things like energy names, oil companies down significantly. Boeing, one of the biggest losers, looking at the S&P 500. So, a lot of that trade that had been rallying very quickly really unwound in a huge way today. In terms of what held up, consumer staples, again, everything was down, but consumer staples almost halved the downturn of the S&P 500, down 3.7%, utilities down 3.8%, communication services as well. So a lot of the better charts that you'll see, things like Walmart, which again still were down, but down so much less than the overall market environment. A little later in the show, we'll have a segment called "It's All Relative." On a big down day, I've always found it's good to see what actually held up, especially on a relative basis, because if this trend persists, those might be the opportunities to find some safe havens and cushion potential downside. Let's look at a daily chart of the S&P and see where we're at. So again, today we sort of gapped lower. We pushed down below the 200-day moving average for the first time since late May. We closed just above 3,000. We touched it almost to the penny there intraday, and we've talked about that 3,000 level. Talked about the 200-day. We're there, folks. So today was a reversal back to support. What happens after this is we either find support here, and this is the next like higher, or we continue to drift lower. What concerns me, if you're sort of expecting that quick return, these sort of days don't tend to happen in big bullish phases. And we'll look at breadth and some other measures hopefully here in a minute to illustrate how big of a downturn that was. Again, it's not saying that the market can't recover. It certainly could, but this doesn't tend to be a one-day experience before we just reverse and test the previous highs. Usually is a sign of more things to come, this sort of weakness. And again, the market overdue for profit taking, overdue to for a bit of a pullback, certainly, but the strength of this one, the severity of it, and the speed at which we've retraced back to the 3,000 level, I think is pretty notable. Looking back at the market recap, we're going to get to some individual names a little later when we talk about some of the relative gainers in this environment. But in terms of industry groups that held up okay, it's a lot of staples. You have non-durable household products, food retailers. This is things like grocery stores and others that again minimized their losses. Also specialty retail, toys, some of the groups within consumer discretionary that you might not normally think of as holding up, but they actually did pretty well today. And then a number of utilities groups actually in the top 10 as well. And we looked at utilities previously. Again, the key there is they tend to be pretty stable, even though they lost in terms of price today, tend to have a healthy dividend component, which a lot of times will help cushion this sort of downside. As I alluded to, the big losers today, besides coal, which is a sort of a small mid-cap group within energy, airlines were down significantly. And if you look at the chart of the airlines index, just on the little preview there, you can see how they went exponentially higher. This is when American Airlines makes the announcement about reopening, the stocks go vertical, and then just like that, we've retraced all the way back to where we were at the end of May, which is a huge round trip for a lot of those stocks, down almost 14% today. Within materials, you have some groups that are down pretty significantly, 10+% as well. Oil equipment and services is one of the large groups within energy, down as well. Aerospace, this is Boeing's group, down over 11%. Steel companies, pipeline. So sort of that MEI sort of trade that's represented pretty heavily on the big losers today. Looking at a couple breadth reads, my mind is spinning as to where all to go here. It's so interesting to think about how to break down this sort of day. And I won't say it's fun, because it's not fun to see this sort of capital loss so quickly. But I think it's interesting to know how compelling this is. The Nasdaq 100 tested 10,000 this week for the first time in quite a while. The question was, is it able to push above 10,000? We've now pulled back significantly from that level. There's a beautiful irony if the Nasdaq 100 ends up topping out around 10,000. That's a huge round number, putting it to 5 digits for the overall index. The S&P just this in the last week had the percent of stocks above their 200-day break above the 50% line. This is not updated for today's close yet, but I would not be surprised to see this come back down pretty significantly, which means this could be just a quick blip above that key level, which usually indicates a rotation back towards more of an offensive tape. Looking at the percent of stocks that closed higher today, this ended up being a 95% up day on the New York Stock Exchange, meaning 95% of the listings closed down from yesterday. There's a 5% up day, meaning only 5% of stocks, 5 out of 100, actually closed higher today. And this is on the entire New York Stock Exchange. So the number of stocks just advancing today was minimal. Pretty much everything was down. And again, if you look at when that tends to happen, it's more in the bearish phase. The last time we had a cluster of these was in late February, which was the beginning of a downtrend. Again, I'm not saying necessarily that we're going to have a repeat of February to March, but price action like today is not what you usually see in the upturns. It's usually what you see in the downturns. The only time that looks kind of like this, but again, very different, was here at the end of March. Just after that first jump higher out of the lows, you had a pullback. Now, this was a gap lower that ended up cushioning the blast. The biggest change was close to close. If you look here, though, we gapped down, and that was the top for the day. We opened at the top, we closed at opened at the highs, we closed at the lows. So directionally, this was just flat out distribution. Whereas back at the end of March, it was a bit of a digestion. You saw some fluctuation. We closed a little bit off of the lows. Not the case here, where we had over 95% of stocks down on the day. So certainly feeling more distributive than accumulative by that measure in particular. That's the best I can do to recap this sort of day in a short period of time. As we get along the show with my guest Xenia Taoubina and also our segment It's All Relative, we'll try to fill in some of the details with the market activity and also on some individual names that are worth your attention here. Let's take a quick commercial break. Back with my guest Xenia Taoubina. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. I'm your host, Dave Keller, here at StockCharts.com. As a reminder, this sort of environment tends to produce lots of questions as you're going through the charts, going through your process, trying to understand things. Shoot us an email anytime, thefinalbar@StockCharts.com. We'll do another mailbag segment tomorrow. We'd love to answer your question on the air. So just shoot us an email when you can, and we'll gather some of those and share them on the air tomorrow. I want to welcome on my guest, Xenia Taoubina from XT Financial Services. And I will start off by saying, Xenia, welcome onto the show. And I have gone on financial television on days like today. I feel your pain in the challenge of how quickly the picture has changed. But I think this could be really helpful to get, for viewers to get a sense of how you are making sense of what we saw today. Tell us what your toolkit is telling you about the environment here.
Yes. Hi, Dave. Thank you for the intro. Today actually answered a few questions that I had about the pattern into the high, because we had seeming acceleration momentum, but we're at nosebleed territory. So the question was, can they push through it? And I think today we're getting the answer. Just by way of background, I use Elliott Wave along with traditional technical analysis and certain quantitative signals to derive the likely path forward. And the way I see this is Nasdaq, once it crossed 9,000 to the upside, it became likely that it was going to push through to a new high. And we did get that high. Now the question is how likely is it that that was all of the move? My perspective is that that is not the most likely scenario. My perspective is that the pullback we're seeing is likely to create divergences for the next high. And that perspective remains for as long as Nasdaq can hold 9,000. So the red line that you're seeing on the chart off of the what we call a V wave high, for as long as that does not see sustained break, My view is that we will see one more high, and that high ideally will reach 10,600 and potentially into 11,000s. In terms of moving on to the smaller time frames, and in terms of the path that we may take from here. In my analysis, I use Fibonacci extensions and retracements quite heavily. And today's move, as of this morning, it did become likely that we'll see continuation of the move. And as it turned out, the little bounce we got in the morning was all we got. So at this point in time, I'm seeing the local move as bottoming. And this chart was captured before the close. It was captured in the afternoon. We closed much closer to the bottom portion of the blue box, which marks the target. So my expectation is that we will test the breakout level of 95.70, or perhaps the low that we saw today, which was very, very close, was all it was. And that off of there, I expect a more meaningful bounce. For as long as this bounce doesn't exceed 99.78, so that's the morning high that we saw, the path is for it to be corrective and to produce a deeper decline, ideally targeting 9,200 area down to 9,000. If Nasdaq is able to make it over today's high, then I have to favor the decline being entire correction, and that we're already on the way to the stated target.
This is fascinating, Xenia, and I love the focus on particular levels, because I think in this sort of environment that, you know, everyone's sort of scratching their head trying to figure out where we would anticipate some sort of reversal, right? Some sort of support or resistance. You know, on your first chart, which is really interesting, and I get sort of your base case, which is we finished now potentially a wave 3. We have a wave 4 down around to this range, 9,090, 9,020, and then a wave 5 that would go higher. I'd love to know what would you need to see that would tell you, okay, this is not a wave 4, this is something totally different, this is more negative? Is there a particular level that we would violate? Is it that 90-20 level, or what would suggest to you that maybe the count needs to be tweaked and that there's potential for further downside?
Very fair question on a day like today, Dave.
That's a dangerous question, isn't that? Okay, I won't hold you to it, but yeah, tell us what you think.
Actually, one of the aspects of my analysis that my clients tend to appreciate is that I look across the time frame. So we started the monthly time frame that still favors higher, and I go down to intraday charts. So today, when Nasdaq broke the opening low, I did issue an alert to our subscribers that we were accelerating down, and that's what ended up happening into end of the day. So the first sign that we that may tip the scale in favor of a larger move is if instead of holding that 95.54 level, which may end up being today's low, or maybe in the morning we'll retest it a little bit. If we do see direct break below this target box, that will produce what in Elliott Wave speak is known as 5 waves down, so an impulse down. And at that point, that opens up potential to more bearish scenarios. For as long as we're holding this target box, odds will favor the next low to be completing the correction. If we break below, at a larger degree, at the daily chart degree, a sustained break back below that 9,000 level that we squeezed through. We didn't break out over it. We literally squeezed through it. Right. A sustained break below it will open up potential for a more significant top, in which case initial support will be in the 78 to 8,200 range. So that's the Fibonacci retracements in green. And the red line that's marked the late February low. And if that's broken, then we likely are heading back to the lows of March. So that's how we approach our analysis.
It's amazing, Xenia. In one day, I feel like we're able to talk about that sort of scenario, which seemed unimaginable just 24 hours ago.
Yes.
Xenia, listen, thank you so much for coming on the show. Really interesting to see your take on things, and I would love to have you back on down the road a bit, all right?
Thanks, Dave.
That was Xenia Taoubina from XT Financial Services, and as you've probably followed on the show, I am not an Elliott Wave analyst, and I have always found it really helpful to talk with Elliottians like Xenia and just get a sense of their toolkit, which is so different from mine as a trend follower, as a looking at momentum, trying to identify turning points like that is a almost a completely different practice altogether. But I have learned so much from talking with people like Xenia and just understanding how they approach things, because again, a market is made up of so many different participants trying to approach things from different ways. What I love about what she shared were some particular lines in the sand that I know, looking at the hourly chart, I'm certainly going to keep in mind. That was a great take on the NDX. Let's move on to our next segment called "It's All Relative." And again, I've seen this sort of day before. And unfortunately, when you are an investor long enough, you will see days like this. The question is just what you do in this sort of environment. I will tell you, on the institutional side, it's always about relative strength. And in days when everything's down, what's down the least? What's actually holding up a little bit, which means it's going to allow you to outperform. In a downturn, when everything's down, you're either in cash or you're in the safest part of the market where you can at least get some income from it, some sort of dividend component, focus on the total return aspect there. Or just find ways to minimize your losses and outperform during that period, and just not, participate in the entire downturn that the S&P is going through. So what we're going to do is focus on some pockets of the market that actually held up a little bit today. I'm going to warn you, none of the charts I'm looking at look incredibly positive. Everything's sort of in digestion mode, but as Xenia was alluding to, I think, when a day like this happens, it happened, tomorrow is really key. And the next day, and going into next week, right? It's how the market reacts to a day like this. And that tells you a lot about where investors are at. Do they treat this as a buying opportunity? And after they've dealt with this short-term loss, do people get back in and try to buy a bounce? Or is this a continued distribution as people are just done with the idea of the market going higher? And looking at some of the charts hopefully will help you understand which of those scenarios is playing out. So what we're going to do is focus on the scooter rankings. Again, if you watch the shows for a while, you know that in the middle of my market, my dashboard, I have these windows looking at the scooter rankings. These are the top ranked stocks on the entire large cap universe. These are stocks within large cap up the most, that have gained the most in their scooter ranking. These are the ones that have lost the most in their scooter rankings. And the easier way to do it on a day like this is just go to the official scooter report. So if you've not done this before, click on charts and tools up at the top. You'll find in the right a little link for the scooter reports. It'll look kind of like this. I'm looking at intraday data, which just means I'm looking at today's movements. It's going to start out showing me the top ranked stocks out of that whole universe, which can be very helpful. I'm going to resort it and look at the stocks that have gained the most. So what this means, if you think about it, you're basically focusing on the relative winners in a day like this, because this is showing you how much stocks have changed in their scooter ranking from yesterday. It's a percentile ranking, which means it's going from the best to the worst. So things that have improved the most means that they've at least, had less of a down move than everything else, which has gone down pretty significantly. That makes sense. So the biggest gainer today was Walmart. And again, I'll warn you, none of these charts that I found look incredibly impressive, but they look a lot less painful than others. What's interesting about Walmart is it's been sort of a non-factor. If you look at the price, after that big move higher from the March 23rd low, you can see Walmart actually came off a little bit after the S&P bottomed. It rallied pretty well and picked up a little bit of relative performance, but overall, the relative trend has been very much down since the market bottom on March 23rd. Potentially that's starting to stabilize. And again, more days like today where it's only down, less than 1%, when the average stock is down 5 to 6%, that's how you outperform in a pretty meaningful way. So even though this is just one blip, a couple days ago, it was flat for the year, and now it's up 7% for the year just in 2 trading sessions. So it's held up pretty well, as a lot of other stocks have came off a little bit. So with something like Walmart, I'd be very much looking at the 200-day moving average, see if it's able to hold that. The 50-day here completely got broken, and for a lot of stocks, they're in a similar sort of condition, especially things that have held up okay on a price basis. So looking at the 200-day and seeing whether it's able to hold above that, I think would be pretty compelling. Second stop that appeared on the biggest gainers list is Broadridge Financial Solutions. And what's interesting about this one, again, even though the relative strength is relatively flat for the last 4 to 6 weeks, if you look at this chart, you would not know that the market has gotten so ruptured in the last 24 hours, because even though it's down, it's actually still above its 200-day moving average. And the reason why I'm focusing on this chart is because A lot of stocks were overbought, just like BR. A lot of stocks have pulled back, just like BR. If stocks like this are able to hold their 200-day moving average, that gives you a glimmer of hope. And those are the charts I would want to own in an extended downtrend. Stocks are actually able to hold support, stay in a higher low scenario, which at this point it's able to do. But if you start breaking down a little further, I think that's where you need to be concerned. So the question with the chart like BR is it able to hold support there as it comes off? I'm just kind of picking some random stocks on here. Viacom, so this is when communication services, this is an interesting chart because it looks very different. The average stock is kind of up here, has rallied above the 200-day moving average, pulling back a little bit. This one almost looks more like a slow and steady gainer, even though it's down almost 2% today. You can see it closed at the highs today. So stocks that closed at the highs, even though, again, that's one day that you're looking at, that tells you something. That tells you that there was demand coming in. So while the S&P sort of opened at the high, closed at the lows, this is the opposite. So again, while it's not the most bullish price chart I've ever seen, it's still making higher highs and higher lows. And if it's able to hold previous lows, especially the previous swing low above 20, I think that would be pretty encouraging for a stock that I think a lot of people have written off. And on a relative basis, not bad on the last 6 weeks, actually. We only have time for maybe one or two more. I'm going to look at consumer staples. As a sector, these have not been great stocks. Campbell's is one that I'm sorry, this is GM Smucker. Campbell's is the next one on the list there. Consumer staples as a sector has not been impressive. And as you can see, as the market has gone higher, Campbell's, GM Smucker has been in a pattern of lower highs and lower lows. And folks, that is not what an uptrend is made of. So even though today it went down a lot less than the market, even though the relative strength tipped up, this is the type of chart I would probably avoid, only because on a price basis, it's breaking down through support. So the only reason why I would feel this is a great place to be is if the relative strength improves enough, if it holds up while other stocks are really getting beaten down. But otherwise, I think it's a scary chart to try and know. Now, Campbell's is a little less painful. This almost feels like a consolidation of sorts, lower highs, higher lows, and it's holding its 200-day moving average. That's what I would be looking at because it's nearing the 200-day, the RSI nearing 40. If it's able to hold that, stocks like this that are able to hold key support levels while everything else is breaking down, that's where I would start to look. So again, it's too early for me to really say what's maybe going to happen with some of these, but those are the levels, those are the patterns that I would be trying to identify to see which stocks are able to hold up on a relative basis. We need to wrap the show, go right to the 3 and 3. And I tell you what, this is a fascinating challenge to try and summarize this sort of day in 30 minutes. I hope I've done well for you. The first chart is looking at our market trend model. The irony I mentioned, because I told you on Monday, if the week ended today, the long-term model would turn positive. With today's sell-off, if the week ended today, the long-term signal remains bearish, which is absolutely fascinating. If this model actually remains bearish as the market would roll over in some extended period, I would be absolutely thrilled and amazed because it's a model I've followed for a number of years, and I think that would be a beautiful way of interpreting what's happened here. A bear, secular, more of a cyclical bear with the short-term uptrend that we've seen. But again, this is one day. What concerns me on this chart, which is what I would tell you if you're more constructive, is we're making an outside week here. It'd be hard for that to reverse unless we have some sort of huge change tomorrow. But overall, setting up as more of a bearish engulfing pattern on the weekly chart. The Nasdaq 100, I think Xenia did a great job of identifying some key levels for me. The 10,000 value is what's so meaningful. I've written on my blog, Market Misbehavior. If you search for market misbehavior, big round number, you'll see some articles I've written about stocks and markets hitting key round numbers. The Nasdaq 100 hitting 10,000 is a pretty meaningful potential peak of sorts. And also the divergence I'm starting to see now with RSI is jumping out of the screen as you see a higher close there and a lower close in the RSI. And then finally, we talked yesterday about fixed income, and I always like to look at the yield on stocks versus the yield on bonds. And again, the rally that we have seen has pushed the yield on the S&P down because you're getting less dividend for every dollar you're paying for the price of a stock. However, you're still getting about 120 basis points more owning stocks than owning bonds, with bonds rallying and the 10-year yield going further downward. Folks, that's our show on a pretty climactically negative day. We'll have to see how things play out tomorrow, so make sure you tune in for the final bar on Friday. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great night.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.